3, 2, 1,
go.
You're on.
All right.
Welcome to the show, everybody. We actually have a live studio audience today.
We do. Live studio audience. Very cool.
He's out of shot, but my brother is here from Ohio to make fun of me after we get done with the show.
Very cool.
With all the 3 or 4 people that actually watch this thing. A few more than that.
Let's hope so. Let's hope a few more people than that, right?
Hope it's a couple more than that. What do you got for us this week?
So before we get into all the show stuff, I just want to talk about a couple of things. The first one is Facebook group management, right? We've talked about it, mostly Conan's talked about it quite a bit over the last couple of weeks, month or so. The group is growing really fast. And the problem is that people don't understand what the group is about when they join the group. Mm-hmm. I'm convinced that it takes a little bit of time to be in the group for a bit to figure out what it's actually about.
Because a lot of people we notice, so we get about 300 people a week that Jerry has to approve each and every one to go through, right, to make sure that, it's a person and not a bot or whatever. Yep. But a lot of people get invited by their friends. Yep. So you don't even know you were invited. So I join the group. I invite 50 of my buddies. Right. And then I don't even know I'm really in this group. And then all of a sudden I get notifications and I'm in it. And so I think that's part of the problem too, is people are just kind of blindsided by, oh, well, this is cool. Thanks for inviting me, but I don't even know why I'm here. Yeah,
definitely is a part of it. At the end of the day, the group is about technical analysis, right? I don't remember if we talked about it on a show before, but I know we've talked about this concept. We've talked about all the stuff that we're going to talk about here again. But the group is designed to talk about technical analysis. Right. So let's just say Elliott Wave. Let's say you're looking at a
technical analysis versus fundamental
analysis.
Basically 2 camps in market analysis, right?
Right. And even honestly, even if you wanted to get on the group and talk about fundamental analysis, that would be fine. The problem is when people get on and
I don't know shit about either one.
Well,
Am I being mean?
The problem is the bashing.
Oh yeah.
Like, hey, I'm new to the group and I just got kind of scared out of the funds or I just got into the funds. What do you guys think about that?
Right. They're genuinely looking for help.
Right.
Which is why we have the place in the first place.
Exactly. Yeah. And so you got people that are new, they're asking these questions and they get beat over the head with a baseball bat and guess what? They never come back.
Yeah.
And
it's unfortunate because those people need the most help.
Yeah, definitely.
It's the person that's like shouting out, "How'd you not know you needed to be in CNS?" Like, they said they didn't. They're looking for help.
Right. Right. That's like number one, right?
All right.
We're technical analysis focused. You want to talk about fundamental analysis? That's fine. You want to talk about some kind of intelligent way that you can grow your, no pun intended, grow your thrift savings plan. Great.
By the way, every time we say grow in a sentence now, we have to say no pun intended.
No pun intended.
We're doing it all the time.
You want to talk about that kind of stuff? Great. If you have some kind of new super system, have at it. It's just the constant bashing that drives me nuts. And people that are clearly in the group that do not understand that we're technical analysis focused, right? We don't do buy and hold. We don't do seasonal strategies. We don't do swing trade. We can talk about those things, but that's not what we do as a methodology in terms of growing TSP.
Right, and those are different ways to play the game, but it's not the way we play the game.
Exactly. There's nothing wrong with any of them.
Right. There is a swing traders group.
Yeah. Oh yeah. It's good.
That's a great place to talk about swing trading.
Yes, I think that's probably true. All of those methodologies work, including ours. Sometimes. None of them, including ours, work 100% of the time.
Yeah, that's the real takeaway, right? Yeah. And people that bash on one versus the other, and usually, I don't see a lot of this. I don't see a lot of people like bashing the way we do it so much as I see people bashing others for not knowing how to do anything.
Right.
Is that a fair kind of assessment?
Yeah. Or there was a guy on that posted this week. It's been a crazy week, so I might get the days wrong, but I think Tuesday the market tanked and he had gotten out on Tuesday and people were jumping all over him.
Really?
Yeah. I'm like, you people have no idea what you're talking about. Right. Like, and he laid out an absolutely reasonable technical analysis like solution to this problem of the markets rolling over.
And based on his personal circumstances.
Yep, all
right?
that.
Nobody knows what his personal circumstances are.
Right. And what ended up, so what happened? On Tuesday, he got out, he got bashed. On Wednesday, the market went higher, so now we really got bashed. But then what happened? Thursday, the market tanked, and Friday it tanked again, and I'm not going to say it's probably going to do anything, but he's in a much better position than we are if you got the alert on Friday, because he moved on Tuesday.
Right.
Right? And he did it for a reason.
Right.
And he laid out his reason.
Yeah.
And so when people, jump up and down on him, it just, I responded to that comment on Facebook because.
You jumped in there.
Oh, yeah. All right. We're
What's
almost
next?
done with this. Politics. No politics. Can't have it. I was a political science major at the Naval Academy. Love to talk about politics. Not in the group.
Right.
Not in the group. Can't do it. No bashing, no politics, and no selling other people's services. That's just not cool.
Or your services.
Or your own.
That person's,
Yeah. It's just not cool. If you want to buy a service, go to our site and subscribe, www.growmytsp.com.
we don't go to other people's group and try to recruit.
No.
It's just
it's not cool.
Yeah, it's not.
No. I mean, I know Scott Zane. We communicate quite a bit.
Yeah.
I don't go to his site and tell his people that they're wrong.
Right.
You know what I mean?
Right.
It's just not cool.
It's
anyway,
just not polite.
Not polite at all.
Yeah.
All right, number 2.
That was
that was number 1.
That was
number 1. Yeah, I only got 3. But yeah.
Okay.
All right.
Man, you guys got Jerry riled up. This never happens.
It's on the weeks that are hard.
I don't think I've ever seen you on a soapbox. This is fun.
I got to work on these weeks. I think the beginning of the post when I did the market update, like on Tuesday or Wednesday or whatever, I'm like, I was agonizing over the thing. I think agony was the word I used, right? And it's true. Yeah. I mean, it takes a lot to make the decisions, and
yeah, well, and I think something that a lot of people that are our members don't appreciate. Some definitely do, especially those that have been following you for a long time. Yeah. But some people don't appreciate how hard it is or how agonizing it is. You're not, even though it is just moving your money. Mm-hmm. You're moving my money because I'm following you. Yep. And you're moving thousands of other people's money. Yep. And, it's not a recommendation, blah, 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 right. Disclaimer. Yep. However, that's happening.
I am painfully aware of that, yes.
So you got all that on your shoulders, which means that at the end of the day, if you make it actually makes me more confident in your decision making because you're always been able to take emotion out of it. You do a great job of that. And then when the weight on your shoulders. Yeah. You accept it and you're like, hey, I know what the impact of this is. Yep. And so if you make that decision, you've clearly thought about that. Yep. And so when people let that soak in, that's why we've got some people that are just like cult following. Yeah. Right. Yeah. They're like, I don't care. I'm doing it.
Yeah. Yeah, that's true. And it's also why it's very hard when, which is most of the time, I want to see what's going to happen with the futures market and what happens in the first hour of trading before I make a decision. Right.
You have to.
Yeah, you kind of have to. But that only gives us, about an hour to get it all together once you've made the decision to do it. It's hard.
Yeah, I actually answered someone who said, like, why did this come out at 11:15? And I sent them your post, the mechanics of an alert. Yeah. It's like we have from 9 a.m. till about 11.
Yeah, 9:30. So the market opens at 9:30.
9:30, yes, at 9, yeah.
Yeah, and the first hour of trading, really, it's all over the place. Right. It doesn't help. So yeah, it's
you got basically hard. From about 10:30 to 11.
Which is coincidentally why the alerts tend to come out at like 11:15.
Exactly. Yeah. As fast as I can type.
Right. All right. Number 2, market timing. Why is it that every time we get 1% or 2 off of whatever the recent high was, we're market timing, and everybody knows that you can't time the market. That in the group drives me craziest the most. It's these people that They yell and scream about how you can't time the market. And I'm like, okay, great. If that's how you see the world, then why are you in this group? Like, if you can't time the market, that's awesome. Then don't time the market somewhere else. You know what I'm saying?
Jeez, man, they got you fired up.
Yes.
Go time the market somewhere else. I'm going to make a T-shirt that says that.
Go time the market somewhere else. So okay, timing. What does that even mean? To time the market. What does that?
Well,
mean?
It implies that you're guessing when you're timing the market.
I would say so. Yeah. I would say that timing the market implies that I'm rubbing my crystal ball and I'm like I'm looking at the market's going up. I'm like, all right, I'm getting out here because clearly this is the top.
Yeah.
And my question to you is, if clearly that's the top, when tomorrow comes and the market's a little bit higher, now what are you going to do?
Right.
When are you going to get back in?
We wait till it rolls over for real because we know it's real.
Yes, exactly.
You got to let it play out.
How is that market
and
timing?
you got to have the stomach for it too.
Yeah, you do.
That's the problem.
But it's
I
just
don't have the stomach for it. That's what got you.
Dude, it drives me crazy. And maybe it's semantics. Maybe it's just me. I don't like the term market timing. Maybe I'm trying to make it into something that it's not, but it works for me, obviously.
Yeah.
When the market goes up, I don't know how this is working. When the market goes up, and it starts to churn at the top, as soon as it starts ticking back down, you can draw the trend line and you can see it's outside the trend. Odds are it keeps going down from there.
Right.
It's not 100%.
It's outside of the channel, yeah.
Yeah. So it's not rocket science. It's not market timing. It's managing. That's how you manage the downside risk.
Mm-hmm.
I mean,
otherwise,
I don't know how else you do it.
Otherwise, just buy and hold.
Otherwise, buy and hold. And do it on somebody else's group, for God's sake. Jesus. All right.
There you go.
That was number 2. Number 3. All right. Now we're getting to it. In case you haven't figured it out, we did a move and alert on Friday, right? Came out Friday morning, so you got Friday's closing price if you did the alert the reallocation that we did. So I missed the move on Friday. For whatever reason, what should I do on Monday morning?
Oh, this is a question you're posing.
This is a question that a lot of people are asking. I know they've already asked it, and I know it's out there.
Yeah.
I missed the move on Friday. What should I do? Yeah, we do. I mean, the getting in sync and the it depends posts are up there, and they're good. This one is a little bit different than most of the rest of them because, and it was also part of the reason why we did that alert on Friday, because Friday was the last trading day of the month.
Mm-hmm.
So anything that you do on Monday, no matter how, what time on Monday you do it, you're getting, well, if you do it before noon, you get Monday's closing price, which is March 1st.
Mm-hmm.
If you do it after noon on Monday, you're getting, March 2nd's closing price. So no matter what you do, you're out of February right now.
Right. We're starting with a clean slate.
We are starting with a clean slate. Yep. Well, everybody is, right. If you're in sync with us and you did the move on Friday, then we're all synced up.
Mm-hmm.
If you didn't, and you're still working on the last move, which was...
What do we do now?
Then what do I do now, right? Very much more difficult to answer that question for this move on Monday, because if you do it and you blow one of your 2 moves on the first day of the month, there's no way of knowing, but it's not a great tactical position to be in.
Right. Because you got the whole month to look ahead of you. Yep. And, February is a short month. We made the move on the last day. You're not really losing anything by making a move on the last day of the month. What you're doing is kind of hedging your bets. Yeah. Not that we're hedging and not that we're betting. But the point is like...
Actually, that was very exactly what we did on Friday.
Yeah, I mean, we're taking a little money off the table, right? So we're still in.
Yeah.
We're taking a little out, and that way if it just goes completely crazy next week,
right,
we can adjust. We're not all in.
Right.
Yeah.
Right. Yeah, exactly. And you'll see it as we go through the charts, but yeah.
Are you done tongue lashing?
Well, pretty much. If you missed the alert on Friday, log in or subscribe if you're not already a member. We have the Getting in Sync post up there.
It's under the Smart Read section.
Yep. If you plan to follow along with our allocations, at some point you're going to have to bite the bullet, right? It doesn't have to be this time, but at some point, if you're planning on following, I don't want to say blindly, but following along with what we're doing.
Right.
If, on the other hand, you're doing your own thing, then I would just be super cautious right now, because as we're going to get into the charts, it hasn't broken down to the point where I've thrown in the towel yet.
Right. Because, and I know you're going to get into this, because the long-term trend, because the indicators, because everything else is telling us where it's going.
Right.
Right. So we got to let it play out.
Right. Yeah. And we're definitely going to get into it. Yeah. So at the end, Monday's the first trading day of March, and what you do absolutely depends on your personal circumstances and risk tolerance. Okay. I have never, as you said, used notes before.
Never jumped up on the soapbox.
But today was the day.
Jerry's always the nice guy.
Yeah, I'm the nice guy. Sometimes that's true, but sometimes, man.
You got the camera shaking. Take a sip. It'll be okay. Now nice Jerry's back. Now nice Jerry's back.
Yeah, I'm back. All right. I can switch pens. All right.
Oh, yeah, don't draw on it with that pen.
Oh, that would suck. Okay. So it was a tough week. Weekly update show, 28 February 2021. I don't know who to ascribe this quote to, but it came out of the NASDAQ on June 6, 2016. Stocks go down faster than they go up, right? But they go up much more than they go down. So it seems kind of obvious, but you look at a chart, and when the prices are going down, they're going down in a hurry. And they go pretty far down, right? We're going to show a chart in a minute here of 50% losses and 34% losses and all that. But when the market's going up, it goes up slower, but longer, right? So that's just a knowledge thing. It's a thing you got to know. So you got to get out at the top early. You can take a little bit more time getting in at the bottom because the price is going to go longer, But at the top, to manage your downside risk, the earlier you can get out at the top, the better off you are.
Yeah, and I think you've pointed out this before, that we have a tendency to get out quicker than we get back in, like you just explained.
Yes.
Yeah, that is because you are more risk averse,
right,
than others, right? Which speaking as someone whose TSP has benefited from that risk averseness, like we tend to not maybe, so we lose a few points, right? But very, 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 if never, very few times have we ever lost any massive amount of money. Right. And we can't count how many times some of our friends have lost 50%, 30% of their retirement in like the matter of 2 days, right? So I would much rather err on the side of getting back in than getting out. Yeah. And so I'm fine with that. Yeah.
You have to have that bigger picture. You have to have at least three different time horizons in mind at the same time, right? You got to look at it and go, okay, well, I'm going to get to it, but my initial thing is I don't want to take a 50% hit to my account. And to avoid a 50% hit, I'm willing to take little 2 or 3% hits along the way to manage that downside. And there are people that will disagree with me, and that's fine. Yep. Again, have those conversations on somebody else's group. But, we're gonna show it here in a minute.
All right.
So, the market this week did not do well.
Down.
This is for the week, so it wasn't any individual day. But for the week, C Fund's down almost 2.5%, S Fund down almost 4.5%, I Fund down about 3%, and the F Fund down almost 0.5%, which is a lot in 1 week for the F Fund. And we're gonna show that at the end. We're gonna do a pretty good deep dive into the F Fund, because that's really the crux of why this week went so sideways. I talked about it in the alert too. If you guys haven't got a chance to read the alert yet that we put out on Friday, definitely take a look at that, because it talks about the F Fund and why the F Fund was what kind of drove the thing. Last week we broke down the S&P 500 into the 11 sectors that comprise it, right? And we also talked about how tech has been driving the market. It's usually always driving the market, which is why you get the XLK basically in line with the price of the S&P. And even here, it didn't have the big dip because tech never went sideways. I didn't do an update of this for the week, but we did talk about this last week. We talked about how tech was falling off even as the S&P was moving higher. And so we were saying, and I think I said, if I had money to put in, I would put it into XLE Energy, which did continue to go up this week, but I would not put any new money into the XLK. And if I had updated this, you would see it that this weekly was down here because the tech got clobbered this week. So what exactly are we trying to do here? If you're new to the group, new to the show, what is our number one goal? Well, rule number one is don't lose money.
Don't lose money.
Right? Rule number two is you got to be in the stock funds when the market's going up, or else your TSP account won't grow. What we're trying to do is avoid these 50, 55, 34. We're trying to avoid those losses. Right?
And that's not time in the market. Sorry.
Yeah.
I'm going to get you stirred up
we
again.
can call it whatever you want. Here's the thing. If I connect these bottoms, right?
Yeah.
I see this double top here. I mean, that's over almost 6 months. That was the majority. That was about 6 or 7 months. The first 6 or 7 months of 2000 created that double top. Okay, and then when it broke below, that trend line that had started back here in 96, when it broke below that trend line, to move some money to the G fund at that point is completely reasonable. You're trying to manage your downside risk. You have no idea how far this is going to go, but you do know that you got, a 1, 2, 3 or 4 year at least. I don't know how far back this goes, but at least a 3 or 4 year trend line, and it just broke right there. I mean, I don't know how else to put it. Okay, and it's the same thing on the getting back in. You connect the tops this time. It wasn't very good. And it's not an exact science, and sometimes you get whipsawed in and out. But we had a double bottom here. And then once we broke above that trend line, the odds of it rolling over again at that point were really low. And if they did roll over, your risk basically was this much.
Right. So
you've managed the risk. You've actually you can calculate it. I mean, to the dollar if you want. How much you're risking. I just don't get why people don't get it, which is fine.
Well, they get it the more that they watch you do what you just did, right?
Yeah.
Sometimes like there'll be people that have been watching this for this whole year and go, "Oh my God, I've heard this 100 times." Yeah.
I'm sorry to all you people out there, and I know there are guys doing that, and they're rolling their eyes, and now they're laughing.
Yeah, but we have to say it though, because they're people. This is the first time, and they're like, "Well, why do you guys do this?" And we're like, "Well, because we didn't lose 50%." In 2000, I can't read that.
2000, I was a top in 2000.
Yeah, we didn't lose it.
Same thing in 2008.
Yeah, none of those. Yep. We didn't take any of those hits.
No. Now I'm not saying we didn't take.
We took a couple points.
Yeah, like right here, that got everybody in and out.
Mm-hmm.
I remember in 2009. So we had 1, 2, 3. I saw this as a one big 3, and that was the 4, and I was waiting for this 5, and I never got it. Right?
But mark it where we got out.
Oh, we got it right here.
Exactly.
Yeah. Now I didn't get back in because since I thought this was going to be the 4, it took me a while. I didn't probably get back in until like up here somewhere.
Yeah, because we needed to confirm it.
Yeah.
After that big of a drop.
Oh yeah. No, and I have no problem with it.
Yeah.
I mean, if you recall, for anybody who was a member, we got out. I mean, right there. And it was because of what was happening inside here at the time. So,
and this is just one chart.
Yeah.
So you can drill in there and see a lot of reasons why that happened.
Yeah. I mean, here's the other thing that's always in the group. You should always be in the S fund. Right? How many times do we read that in the group? And
what basis do you make that statement?
Well, because the S fund always goes up.
Yeah.
But anybody who has been around for a while, anybody who has retired or is close to it, our age, whatever, if you remember the early 2000s, so back in here, I guess it was probably, when did we go up? 2004, 2005? Yeah. So it was 2005, 6, 7. So this in here was the run up in the early 2000s. That's the C fund. I wish I had a chart. I'll pull up a chart at some point of the ratio of the I fund to the C fund over that time frame.
The S or the I?
I. The I fund absolutely crushed the S and the C. I mean, I could name off guys that were like millionaires in TSP because they saw it and they put all their money in the I fund and they left it and they wrote it. They probably wrote it down too, but well, because they wrote it and they probably wrote it down.
Right.
Anyway, this is just to say that the S fund is not always the place to be. It's just not. When it is, great. When it's not, figure out the one that is.
Because the market doesn't really care what we think.
Market doesn't care. No. No. Okay. So anyway, that's that in the big picture, big scheme of things. That's the point. Avoid these losses. Okay. So how do we do that? We got basically 3 things in the toolbox. Okay. We got Elliott Wave theory, technical analysis, and pattern recognition. Okay? So we're going to talk about those three things first, and then we're going to kind of apply them to the 6-month daily charts of the TSP fund. 3 TSP funds, and then we're going to look at the F fund. All right. We could do, and we have done, some pretty deep dives into the Elliott Wave, but all I'm going to do here is say this. There are 3 cardinal rules, and everything else is a guideline. So in terms of Elliott waves, there are 3 rules that cannot be violated, otherwise the wave count is wrong. I hate rules, as some of you certainly know. I hate rules. But these 3 rules cannot be violated, otherwise it's not an Elliott wave pattern. Okay. Wave 3 can never be the shortest impulse wave. The impulse waves are the waves that are pushing in whichever direction we're going, right? Usually it's up. So wave 3 cannot be the shortest impulse wave, right? And the impulse waves are 135. So wave 3 can't be the shortest of the 135. Wave 2 can never go beyond the start of wave 1. So what does that mean? Rather than going forward, I'm just going to go back and look at this. We know that this is the 5-wave advance that we're in right now, right? We've talked about it a million times. Here's the 1. Here's 2. If this 2 had continued down and got below the prior low, it's not a 2, which makes this not a 1. Okay? Pretty simple. In this case, you got the 1, the 2, the 3, which is the longest, the 4, which the 4 can never cross into the same price area as the 1. So what does that mean? Here's the 1. Here's the 4. The 4 cannot take out the whole advance of the 3 because it would put you back to the 1. Okay? That's it. That's all there is to it. Those are the only rules. Everything else is a guideline. Okay. This is a great site. Take a picture of it and then, throw it in your browser because it's a great site. It's got a whole big deep dive into Elliott Wave, and it's definitely worth the read. This is what we're looking at right now. Okay, so how does Elliott Wave actually help us? This chart goes back to 2006. How is a chart that goes back to 2006 going to help us? Well, here's the thing. What the heck just happened there? Okay. Here's the 1. Here's the 2. Here's the 3. Here's the 4. And here's the 5. So I have the 5 with a question mark up here because we don't know. Right? We
don't know how far.
Right, we don't know how far it's going to go. But what we do know is what happens in the 5 is not part of the rules. Right? So ordinarily, the 5 leg is roughly the same as the 1. So generally, that's what you're going to see. That's the guideline. And ordinarily, just like in the 1, you're going to see the 5 leg expand out in 5 waves itself. Okay? So we talked about it last week. 1, 2, 3, 4, 5. That's what we would expect to see to finish up this pattern. But it's not a rule. It's a guideline. Mm. Okay? So what that means is, really, number 1, we're on borrowed time. Right? Because we've already established that this rally that started back in 2009 has completed, for all purposes of the rules, has completed the full five waves. So we're on borrowed time. No doubt about it. Now, just because we're on borrowed time doesn't mean that the thing can't get up here another 20%. And I don't want to miss that 20%. Mm-hmm. Right? So you have to be able to balance the stuff, like both of it in your head. In the long term, I'm getting the end of the race. I know I'm getting to the end of the race. But in the short term, I don't want to give up that last 10 or 20% or whatever. And I know that The chances are when it rolls over, it's going to roll over pretty quick.
Yeah. So we got to get what we can out of this
Yeah.
fifth leg. And like, using the race analogy, you don't want to quit before the finish line.
Yeah, right.
Like, it doesn't make any sense.
Okay. So all that to say, at this point right now, Elliott Waves, in terms of daily reallocation and all that, isn't doing anything for us. It's run its course for the big rally. It's run its course because we're already there. So we moved to the second thing, which was technical analysis. Actually, before I go to that, let me just do this. This is what this is the 5 leg right here. That's it. Okay. We expect
you zoomed into the 5 leg.
Yes, zoomed into the 5 leg. We expect that the 5 leg will progress out in 5 waves, right? And we know that each of those waves subdivide into 5 waves. For example, 1, 2, 3, ABC is 4, 5. That gives us the 1, right? We had ABC correction for the 2. Now I'm looking for some kind of pattern to get us up to the 3. That's what I'm looking for. That's what I expect. It's not a rule. It's a guideline.
Mm-hmm.
Okay? If this thing rolls over here and comes down, it's not because Elliott Wave was wrong, quote unquote wrong.
Right.
These are guidelines. There's no crystal ball. The guidelines are pretty good to have, but it's not 100%.
Yeah, and what's less of a crystal ball is the fact that it's not just you saying that, it could do this. No, you back out farther like we just did, and it's very improbable. It's possible.
Possible, but not.
It's
not
very
probable.
improbable.
Right.
And as soon as the folks that follow us put their analytical hat on, that all starts to make more sense.
Yep.
We work in probability, not possibility.
Yeah, definitely. Yep. Okay, so that is it for the Elliott Wave piece of this. Number 2 was technical analysis, right? So what are the things we do in technical analysis? Trend lines, moving average lines, volume, support and resistance, technical indicators, right? MACD, stochastics, RSI, all that stuff. Those are all technical analysis. So if we look at this chart again, from a technical analysis perspective instead of from an Elliott Wave perspective, we have well, not ordinarily, but what you want to do as the thing progresses more, you actually want to draw the line from the 2 to the 4, wherever that is. That's what you want to do, and then the 1 connects to the 3, and then that's a much more effective channel. We're just not there yet, which is why I started down here at the bottom. But we do have a pretty good parallel channel right now. So there, when I say channel, this is the upper channel line, right? This is the lower channel line, or could be called the trend line. Every time, which is only once here, we hit this line, it bounced higher. So we'll see what happens here. Because here we got both the 50-day moving average, which is the red line, and the lower trend line coming together to provide support. Okay. So we'll see what happens. If we get support there, great, the market moves higher. If we don't get support there, the market continues lower, that's fine. Why did we, well, no, we'll get to that in a minute. But so that's a way of looking at the 5 leg that we're in right now from a technical analysis instead of a Elliott Wave perspective. The other piece is moving average lines, and this is the same chart just without the
channel,
without the Elliott Wave count. And there are people that have been asking, like, what is this thing with the trend lines? How do you know which one to use and all that kind of stuff? You can see in the chart that the 10-day is the blue line. So for most of the time, the 10-day, the price bounces off the 10-day. I mean, for the vast majority of the past year, price has bounced off the 10-day on a daily basis, pretty much. When it broke through the 10-day, right, it would come down to the 50-day. It didn't happen very often, but when it did, it would come down to the 50-day, right? And on the even less likelihood that it broke through the 50-day. It came down to the 100-day. It never got to the 200, but it came down to the 100-day moving average actually 3 times. And this is for the past year. So those 3 moving average lines tend to be pretty good. And since right now we've broken through the 10-day clearly, and we closed the week, right on the 50-day moving average. So we took some money off the table.
Right. So it could find support?
It could find support,
and move,
sure.
Or it could go through it.
Yeah. And if it finds support, what will we do? This is a test question.
For me? Yeah. Oh, man, I hate it when you test me. We get back in.
Yeah. When will we get back in?
Once we confirm that it's staying above the 10-day.
Above the 10-day, exactly.
Yeah.
Once we close above the 10-day, we get back in. So what does that mean? We will absorb. We will absorb this little, not loss, lack of gain.
Lack of gain. That's a good word. That's a good way to describe it, because people are like, "Oh, you locked in your losses." Okay, lack of gain is a much better way to look at it, because we're not. Yeah, we had a little loss. Back to the big picture that we looked at a few minutes ago. Yep. We're not taking a 34 or 55%. Right. We're not doing that.
Right.
So that's how you don't do that.
That's right. You can't have it both ways.
Right.
You have to pick whether you're going to be in the stock funds or not.
Right. So we're going to wait and confirm this.
So we're going to confirm it. Yeah. If it closes next week, actually I'm going to get into that next in pattern recognition, because I haven't really decided exactly what I'm going to do.
You don't have the data yet.
I don't have the data yet, and it will be another agonizing day if it does happen. Anywho, that's about the highlights for technical analysis as opposed to Elliott Wave. The third thing was pattern recognition. Okay, you can go to plenty of websites. This one here at the bottom is really, really good. It lists the top 11 most common patterns. They're both top and bottom patterns, but it's a really good site. What we're going to look at today is the head and shoulders topping pattern, because I'm a little bit concerned that if that head and shoulders topping pattern plays out, we are very likely in the midst of a major top. Okay. But the pattern, we've talked about some of this stuff before. Cup and handle, I don't think we've talked about, but it's a great one if you read Investors Business Daily. It's like their favorite bottoming pattern. Double top, double bottom, triangles. For a long time, we talked about the flag, the pennant, which was was this for a long time. We had until we got out of the pattern. We had this pennant going on, and it was very tough. Okay, head and shoulders. Here we go. The market comes up. Comes up. You get nice up volume, right? The black volume is positive days, and the red volume is down days. So in this section right here, you got really good positive volume as price is going up. Then price comes down and finds support somewhere. Okay. Recovers and makes a higher high. And then rolls over and makes the same low as this low here. Okay. Then comes back up to basically the same height as this one. So the right shoulder and the left shoulder tend to be the same, and then rolls over. So we get a left shoulder, a head, and a right shoulder. Okay? And most importantly, really, we get this thing called the neckline. This head and shoulder pattern, when it is confirmed, it's like 80 to 90%. The rules almost always apply. And the only rule really is that if the pattern executes, the distance from the top of the head distance from the top of the head to the neckline is the minimum distance from the neckline to the bottom of where the price bottoms out. Okay? So in this case, all you have to do is take the price at the top of the head. We're saying that's the head. The price there was $39.50. The neckline is $3,700. Okay? It's neckline right here, $3,700. So you subtract them out, you get 250 points. You subtract 250 points from 3,700, you get 3,450. So at a minimum, if the Head and Shoulders plays out, we get a price down here at 3,450. Minimum. I wish I could. I should have done this. I thought about it, but I didn't do it. I don't know if you guys can see it in there, but there's actually a little Head and Shoulders pattern in the head. If you looked at this piece right here, why does it do that, man? If you looked at this piece right here on an hourly chart, you would see that a Head and Shoulders pattern was there, and it broke down. And if you can see that day right there, we can't trade this stuff in TSP because it happens too fast. You can't trade that Head and Shoulders pattern, but it would look exactly like this one. Okay, so why am I even bringing this up? I mean, we could just have a trend line that just continues. You know, you could find support there at the 50-day and continue on. But if it doesn't, and it does come down to 3,700, recover a little bit, say back up to the 10-day moving average line, which by then we'll be doing like this, hits the 10-day moving average line and then rolls over to that 3,700 again, now we have a giant red flag. And since we know at some point this bigger 5-leg pattern is going to end, we have to be on alert for some kind of topping pattern. And this would be a really, really good one. Doesn't mean it's going to happen, but it would be a really good one. Okay. All right. Basically, that endeth the lesson. But we're going to apply the technical analysis basically to the TSP stock funds and then the F fund. We're going to go through this kind of quick. We've definitely seen this chart over and over for the past hour almost. We are at the 50-day moving average. We've been here before. The million-dollar question is, will we get support at the 50-day moving average this time? There's no way to know. But, I mean, it looks exactly like it looked there prior to the day that it recovered off it, right? So easily we could get an up day right here. Easily. But since it closed, actually the intraday price broke below the 50-day, and we closed right on it. I based on my personal circumstances and risk tolerance, and the fact that the indicators were way rolling over, and we had increasing negative volume for the last several days, I took some of my account off the table. All right. S fund, similar but different. We got support at the 50 on Friday on the S fund. And we had a bit of a reversal day. It closed basically where it opened. It was a better reversal day until about 3 o'clock, about 3:30 really. By 4 o'clock it had come back down, but at 3 o'clock it was basically at the top at 2150. But again, indicators are rolling over. MACD already crossed. So can we get support here at the 50 on the S fund? Absolutely. I'm just not 100% convinced that we will, and therefore my allocation reflects that concern. I fund looks, ugly, right? This was pretty good. We had a pretty good move here, and it all went away in 2 days. and it closed below the 50-day moving average. Huge negative volume, much bigger than the CNS fund in terms of volume. And kind of importantly, because you don't see this on the other charts, we got a declining MACD and a declining RSI, even as the prices are continuing higher. That's classic fifth wave, which is fine. We just have to know it. There's a divergence going on, and it means eventually the price is going to cave in. When are we in the midst of it right now? I don't know. Maybe not. Maybe we're very alert to it. But yeah, that's what technical analysis does. Right?
Absolutely.
Okay. F fund.
It's a very, very different chart.
Yeah. Yeah. If you read the alert, it goes into what the F fund is and why it looks much different than the stock charts. The F fund is a bond fund, right? And so if you're reading the paper at all, on the one hand, you got the Fed that came out last week and said where rates are absolutely not going up. We're going to pump as much money into the system, and you know, we're not going to let the party end. Great. The bond market does not believe it.
It's not buying in.
It's not, and it's reflected in the chart.
Yeah.
It just doesn't buy it. I mean, there's an old adage that says "Don't fight the Fed," which is great, but the Fed is like the 100-pound gorilla in the room or whatever. But it's not the only animal in the room, right? If you own a bond that's been paying you 2%, let's say, and that you own a bond in Amazon that's been paying you 2%. If Amazon comes out with a new round to get financing, you're looking around going, I don't want 2% isn't cutting it for me anymore. I want 3%, right? So Amazon says, okay, I can't issue as many bonds at 3% as I can at 2%, right? So the point of bonds get a little bit tricky, but as the yield that your rate of return on the bond, as that goes up, the price of the bond goes down. So when they say that the yield on the 10-year is rising, when you hear that, the price of the F fund is falling.
Mm.
Does that make sense?
Yeah.
Okay. So bond rates don't change a whole lot ordinarily. And when they do change a lot, something's going on.
And that's why we like them for some things, is because they're stable.
Yeah, they're stable.
Right.
They're stable. And generally they make
reasonably stable.
Yeah. And they're a generally a better rate of return than the G fund. But when they're not stable, they're not worth, if your objective is to minimize your downside risk, the G fund has no risk.
Yeah.
Now, it doesn't have much of a return. It has some return, but not much of one. But at least you know you're going to get one.
Right. You're not going to lose.
You're not going to lose. Right. And the F fund right now, it's just not looking good. So I have two charts of it, and the first one is 1 year, and the second one is 9 months. And you see very different things, basically, because in the first one, the chart had to incorporate this big drop from COVID in March. But we had a complete collapse, and then a recovery basically back to where we were, and then it continued on. What happened, though, if you look at this section here versus this section here, let me see if I can kind of drill in. You can see it. The section on the left, the days in black, the volume days, are higher than most of the volume days in red. Not all of them, but most of them are, the days in black are higher than the days in red on the left side. On the right side, most of the days in red are higher than most of the days in black. Right?
Mm-hmm.
It's a huge giveaway because as big, funds buy bonds, they're not like the little guy. The little guy buys, what is it? Not Redfin. What's the
Robinhood?
Robinhood, yeah. You're not buying bonds on Robinhood, right? People that know what they're doing are buying bonds, not us. Okay, so what they do is they buy them in big chunks, And that is the beauty of volume. You can't hide. You can't hide.
Doesn't matter who it is. We know if there's big volume.
Right. Then something's happening. Yeah.
Yep.
So just an analysis of the volume, that should tell you quite a bit. You made a high here, right? The second high was lower, okay? And the volume here on the second high was much lower than the volume on the first high. And you got the RSI up here, and the RSI only hit here on the second high. It was extremely obvious in here somewhere that it was a matter of time for the F fund, right? So those are the huge red flags. Here's where it actually happened. Okay. You draw you get the high, this first high that we talked about in the last chart, and this was the second high. So you have lower highs, which gives us the ability to do a downward trending upper channel line. Then you clearly get support here at 116.50. Right? It's flat, 116.50. So we have this bearish triangle. It's bearish when it's flat on the bottom and angles down on the top. That's a bearish triangle. So what happened? At some point, it gapped down through the bottom and kept on going. It was absolutely foreseeable. And even, so it was, I won't say it was foreseeable. I'll say we had all kinds of indicators just based on the volume and the technical indicators, RSI and MACD. We had plenty to make us expect that the F fund was going to roll over. And since we had a very clear support at 116.50, once it gapped down through that line, that was it. I mean, if I had been in the F fund at that point, I definitely would have sold it. Fortunately, I wasn't, but that's that. So, and at the same time, I mean, this is a huge move down for the F fund. You know, the F fund doesn't trade like this. It trades flat, like you saw in the last chart. So, right now, so don't get me wrong. I'm not saying if you're in the F fund, you should get out of it now, because we're now at oversold levels. So the technical indicators are starting to tell us that now might actually be the time to get back in.
Right.
Maybe for a short time, who knows? But
yeah, it's definitely something to watch.
Yeah, right. If I owned it now, if I had ridden it down to this point, I wouldn't sell it.
Yeah, don't get out.
No.
Now's not the time to get out if you're in.
No. That was the time. That was the last best time to get out right there. I'm done, bro.
Now we need a question slide.
Questions.
Oh, now you're done. You're never done until the question slide comes up.
You can't. You're right. You can't not make it to the end of the race.
You can't. So, to wrap all that up, don't mess around in the Facebook group where you're going to get Jerry pissed.
Seriously.
And the other big takeaway though is honestly, like you saw the gist of the program this week was talking about technical analysis and really digging under the hood. And we're constantly adding things to the site to kind of explain this. We're working on, if anybody saw the kind of teaser in the Facebook group, we put up what we're calling the roadmap to retirement that kind of lists all the large topics that we're going to cover in that there's going to be learning modules for days on all these kind of things to dig under the hood. You know, and the benefit to you is if you truly have an interest to learn this, yep, it's difficult to find a place to learn it, right? It's particularly the way we do it because it's there are places to learn about technical analysis, obviously.
Yep.
How to use that and apply it in the process that we use for TSP.
Right. Only to TSP.
Only TSP is a little different, yep, right? So anyway, we're working on those educational tools to help you, and that's, you know, constantly our efforts are pushed into doing that. Hopefully you guys find it valuable. If you have any questions this week, make sure you put them in the comments on Facebook, comments in YouTube. If you like the show, please share it.
Share it with your friends.
Yeah, and if you want to make sure you catch it every Sunday, 6:30 East Coast time, it comes out on Facebook. And then it's about 6:45. It's posted on YouTube. If you subscribe to the notifications on Facebook and YouTube, then it'll just tell you, yep, and you'll be groovy. You'll have it.
You'll be groovy.
All right, we're going to go have dinner and enjoy ourselves the rest of the afternoon. Hope you guys have a great week. And as always, thanks for watching the show.
Peace.
I got to play some music, though. Bam.